more on this, let's bring in Stephen Innes, who is the Chief Global Market Strategist over at AxiCorp, and he joins us now from Bangkok in Thailand. Stephen, good to have you on the show. So a lot of turmoil, a lot of volatility we're seeing in the last couple of days. Is this latest surge only to do with these heightened tensions between the US and Iran?
Quite interesting. Yeah, mercifully, we've recovered from a 21-year low in oil price, and it's sort of the feel-good story for the day, really, when we think about it. I think the short covering bounce started after President Trump, that's for sure, but there's a couple of other elements that are adding to the flavor of oil markets today. The one, looking at the June contract itself, the big USO ETF fund that had been pretty much responsible for the big meltdown into the May settlement issue is actually averaging their positions out across a number of contracts. So that's in itself is taking a lot of settlement risk off the June contract. And also the markets are starting to warm up to the fact that U.S. Congress could start to paint the energy ticker green with a thick coat of proration. What that really is, it's just a cash swap to encourage wells in Texas to shut. And in other words, they're just going to compensate the producers with cash to effectively close down production.
Okay. I'm wondering where the market goes from here, because the world is still awash in a massive oversupply of oil. Demand for black gold has pretty much collapsed because of COVID-19. What are going to be some of the driving factors in the market moving forward?
Oh, definitely. It's going to take more than a celestial alignment to get WTI trading above $20 going into the end of the month. It's just an immense problem we have here. It's just a total demand devastation running head into a supply glut. That's not going to alleviate anytime soon. Sure, there could be some more suasion from OPEC and what have you, but it's unlikely that any immediate supply cuts are going to change that narrative where tanker storages in the U.S. are actually going to saturate in May. And this is the ultimate problem here. Once the storage infrastructure fills, then there's really no place to produce oil. So in theory, if oil production remains steady, then there's oil prices just by supply-demand factor are going to head lower. But all eyes are on what the government's response here. If we can get a significant cut, and I mean a significant, we're looking at somewhere in the neighborhood of about 20 million barrels per day cut, along with some type of recovery in demand, unlikely as that may seem with everybody still in lockdown, there's a possibility we could see an uptick in oil, in the next little while. But it's certainly going to be, lights out for oil this quarter. We're really looking towards the second half recovery for oil prices right now as that stands.
I mean, you're calling for a $20 million a barrel cut. One of the things that actually got us here was that that argument between Russia and Saudi Arabia. How does this affect producers going into the second half of next year?
Well, ultimately, there's going to be a lot of pain felt, across the globe here. Anybody who's a price taker of oil is going to be suffering. I'm referring to producers throughout the globe, whether it's Kuala Lumpur in Malaysia, whether it's Calgary, Alberta in Canada, whether it's the Middle East, whether it's the U.S., everybody's going to be suffering for this. And this is why there's such a rush here to do something about it, because it's just not necessarily the oil price that's the concern here. It's also the knock-on credit risk, because a lot of banks are definitely exposed to big oil in some way or another. And this is the real problem that we're facing, and why I think there's going to be more of a coordinated effort to try to maybe not push oil prices higher, but at least stop them from falling. And I think that's the best we could possibly hope for going through the early parts of the summer.
Okay. Stephen Innes, live for us from Bangkok in Thailand. Thank you very much for that.